Every time you tap a Visa card, Visa can earn money without selling you the card, lending you the money, or taking a simple cut of the purchase price. That sounds impossible because the Visa logo is on the card, on the terminal, and often in the payment app. But the company's real product is not plastic. It is the network behind the payment, the infrastructure that connects banks, merchants, cards, accounts, wallets, and transactions at global scale. Visa explicitly says it is not a financial institution. It does not issue cards, extend credit, or set the rates and fees paid by account holders. Those jobs belong to banks and other financial institutions. Visa's role is different. It operates VisaNet, the system that helps move payment information between the businesses involved in a transaction. Picture a customer buying a coffee with a Visa card. The merchant is connected to an acquiring bank, often called the acquirer. The acquirer sends the transaction data through VisaNet to the bank that issued the card. The issuer decides whether to authorize the purchase. Then the issuer pays the acquirer, and the acquirer pays the merchant after deducting applicable fees. Visa sits in the middle of that communication and coordination. It helps route the request, apply network rules, manage security, and return an authorization decision quickly enough for the customer to experience the transaction as nearly instant. The money does not come from Visa owning the coffee shop, holding the customer's balance, or collecting interest on the cardholder's debt. It comes from providing the infrastructure and services that make the payment possible. That distinction matters because a card payment involves several different businesses. The issuer may earn interest or account fees. The merchant's acquirer may charge for accepting payments. Other participants may receive fees connected to processing or settlement. Visa operates the network that links those participants together, and it charges for access to the capabilities of that network. The scale is the crucial part. VisaNet connects approximately 12 billion cards, bank accounts, and digital wallets with more than 175 million merchant locations across more than 200 countries and territories. That creates a powerful network effect. A card becomes more useful when more merchants accept it. A merchant benefits when more customers can pay with it. Banks want to issue cards that work in more places, while merchants want to accept a network customers already carry. Every additional participant makes the system more valuable to the others. Visa spends money to strengthen that loop. It invests in acceptance, technology, risk controls, security, and incentives for financial institutions, sellers, and other partners. The goal is not simply to process one payment. The goal is to increase the number of cards, merchants, and successful transactions moving through the network. Once that network is established, revenue can grow with activity. More payment volume means more data to process, more network services to provide, and more opportunities for cross-border transactions and additional technology products. In fiscal 2025, Visa processed 257.545 billion transactions, up 10% from the previous fiscal year. For the 12 months ended June 30th, 2025, it reported nominal payments volume of $13.894 trillion. Those figures describe the economic activity moving across the system. They are not the same thing as Visa's revenue. Visa does not simply take a percentage of every dollar paid. Instead, its revenue is divided into categories tied to the services it provides and the activity that drives demand for those services. The largest reported category was data processing revenue, at $19.993 billion in fiscal 2025. This is the clearest expression of Visa's core function, processing the information that allows transactions to be authorized, routed, and handled across the network. A payment is more than a message saying that a customer wants to spend money. The network has to identify the relevant institutions, transmit the request, apply operating rules, support authorization, and help maintain a secure and reliable system. At global scale, that processing capability becomes a product in its own right. Visa also generated $17.539 billion of service revenue in fiscal 2025. Visa describes payments volume as the primary driver of this category. As more payment activity flows through the network, banks and other clients require more of the services that support their participation. Then there is international transaction revenue. Visa generated $14.166 billion in fiscal 2025 from cross-border transaction processing and currency conversion activities. Cross-border payments are especially valuable because they involve more complexity than a domestic purchase. A transaction may involve a card issued in one country, a merchant operating in another, and currencies that must be converted. Visa's network helps coordinate that movement, and the added complexity supports a distinct revenue stream. The company also reported $4.053 billion of other revenue. This category includes value-added services, brand and technology licensing, account holder services, certification, and licensing fees. That category points to an important shift in the business. Visa is not only operating a transaction rail, it is building products around the rail. Those products can help clients with fraud prevention, data, security, consulting, digital payments, and other operational needs. Visa's value-added services revenue reached $10.9 billion in fiscal 2025, up 24% from fiscal 2024. These services use the network's position and data capabilities to solve problems that go beyond sending an authorization request from one bank to another. The company's reported revenue growth also follows the underlying activity. In fiscal 2025, service revenue increased 9%, data processing revenue increased 13%, and international transaction revenue increased 12% from the prior year. But there is another part of the model that can look confusing: client incentives. Visa recorded $15.751 billion in client incentives in fiscal 2025. These were payments made to financial institutions, sellers, and other partners to grow payment volume and acceptance. At first glance, paying partners seems to contradict the idea of a highly profitable network. In reality, it is part of the network strategy. Visa may provide incentives to encourage a bank to issue more cards, a merchant to accept the network, or a partner to promote Visa-based payments. The immediate payment is a cost, but the intended result is more activity later. This is the same basic logic as building a platform. The network spends to attract participants, then earns when those participants use the platform. The more deeply embedded the system becomes, the more valuable the connections can be. That also explains why the Visa logo appears in places where Visa is not the lender and is not the merchant's bank. The logo signals access to a global acceptance network. It tells customers that their payment credentials can work across a broad range of businesses, and it tells merchants that they can reach customers carrying Visa products. The company's economics therefore depend less on owning individual customer relationships and more on being the infrastructure that many institutions rely on. A bank can issue the card. Another company can provide the checkout terminal. A merchant can sell the product. Visa can still earn revenue by supplying the network that connects all of them. This structure separates Visa from a traditional bank. A bank's earnings can depend heavily on lending money and managing the risk that borrowers will not repay. Visa's central role is to facilitate payments and sell related services. It benefits when payment activity grows, without being the institution that extends the cardholder's credit. The model also explains why reliability and security are not side projects. If transactions fail, merchants lose sales, customers lose confidence, and banks have less reason to use the network. Visa must keep investing in authorization, fraud controls, cybersecurity, acceptance, and operating capacity, because the network's value depends on trust as much as reach. In fiscal 2025, Visa reported net revenue of $40.0 billion, an 11% increase from fiscal 2024. Its GAAP net income was $20.058 billion. Those results are the financial outcome of a system designed around scale. The company is not trying to make a large profit from one individual purchase. It is trying to become the standard connection through which an enormous number of purchases can move, while adding services around that connection. The hidden mechanism is simple once the roles are separated. The bank issues the card and may extend the credit. The merchant's acquirer connects the seller to the payment system. The merchant provides the goods or services. Visa operates the network that allows the transaction to travel between them. Visa makes money when clients use that network for payment processing, when payment volume drives service revenue, when transactions cross borders, and when businesses buy additional technology and value-added services. It also spends heavily on incentives that expand acceptance and increase future activity. So the next time a payment is approved in an instant, the important question is not, what did Visa charge me? The more accurate question is, what network made this transaction possible and who pays to use it? Visa's business is built around that answer. Its product is coordination at global scale. Its advantage is the network of participants already connected to it. And its revenue grows when that network becomes harder for banks, merchants, and consumers to do without. The card is only the visible layer. The real business is the infrastructure underneath.